The interesting thing is, what was being disclosed the very next day by the chairman, Jerome Powell, was actually saying we're going to support the market going forward as long as COVID is here, and that means reducing the interest rates. The US Central Bank, also called the Federal Reserve, or commonly called the Fed, it's actually being shaken by a big scandal involving Fed officials, including the vice chairman, who back in 2020, in the midst of one of the biggest crises the economy has ever seen, were actually trying to make the best they could in order to support the markets. And in the midst of all that, they actually traded stocks, hence breaching the code of ethics of the entire bank. As a result of that, pressure was put onto Jerome Powell, the Fed chair, to actually do something. And as a matter of fact, we're going to see in this video that he didn't really do much, because even though two of the three officials in the shade of the light decided to quit, there was no money return and no really legal action taken. Why is that? We're going to discover. So we had about three Fed officials involved in this scandal. First of all, let's talk about Vice Chair Clarida. Clarida is the vice chair, meaning he comes right after the chairman. And he was part of the committee that actually started to think about shifting the monetary policy. In simple language, when COVID hit in 2020, markets went down. Everything crashed, and people were seeing in this one of the worst crises, even worse than the 1929 crisis. All right. So the Fed, as the central bank, had to jump in and do something to put up with the fire. So they decided to shift the policy, meaning decrease the rates, the interest rates, all right, in order to allow people to take some more risk and to take some more money into the market, hence preventing them from crashing down. So that decision was actually supposed to be disclosed publicly on February 28th of 2020. Now, documents reveal that the very eve of that day, so February 27, the vice chair, Clarida, moved the money going from $1 to $5 million that was originally held into bonds. Okay, bonds are these assets that pay you interest based on, the interest rates. So he moved $1 to $5 million from those assets paying interest to stocks. But the interesting thing is, what was being disclosed the very next day by the chairman, Jerome Powell, was actually saying we're going to support the market going forward as long as COVID is here, and that means reducing the interest rates. So if you have your money tied into the bond market and interest rates are high, you are getting a higher coupon, you're getting a higher passive income, you're getting a higher payment every month or every 3 months. But if interest rates are decreasing, that level of money you were used to receive will go down. So why in the heck a chair, part of the committee that actually decided those, were moving and shifting that much money the very eve of that being disclosed as public information into stocks? That's a big question, all right? Now, the other Fed official is one of the regional bankers. Regional bankers are pretty much like what we call the governors of the Fed in major cities or major states. So we had the Dallas Fed president, disclose that in 2020, he purchased 27 assets, including funds, including ETFs, and including individual stocks worth each over $1 million, plus another $1 million spread around 22 individual stocks and funds involving Apple, Tesla, Google, Amazon, Alibaba, and Johnson & Johnson. So if you pause here for a second in order to analyze these trades, if you look at how the market went down in 2020 and actually recovered a little bit slower after, these stocks, the Alibaba, the Apple, the Netflix, what we call the FANG, so the high-tech growth, actually were those which actually outperformed the market then. So it was worth putting that money into those outperformers, those gainers and runners, because the amount of money people made buying those stocks back in 2020 was actually unimaginable. So did he know something was about to happen, and that's why he moved that much money into those specific stocks? I don't know. Now, moving now to Boston President Fed. He actually invested millions of dollars into what we call mortgage-backed securities. These are assets that are kind of, debt that people will tend to take, but are kind of underlined and backed by the mortgage industry. So the interesting thing here is he invested this much money, that much money into those type of assets, which was, interestingly enough, and without surprise, the same type of assets that the Fed was also buying in terms of hundreds of billions of dollars every single month. Every single month. So I don't know if you see the conflict of interest here. I cannot work for a bank knowing that the bank will actually invest into a specific type of assets, into a specific type of sector, or it's going to change its policy, and that will actually shift things into the economy and be advantageous for a specific type of companies. Knowing exactly what is happening, because I'm not only working for the bank, but I'm hosting a very privileged and high profile position. It's not only not ethical, but I would be very surprised if that wasn't a breach of, the insider trading code of violation, because it smells here. So that was the whole issue that happened a couple of weeks ago. Now, keep in mind that the Fed Chair, Jerome Powell, is actually in the middle of, he's going to the last months of its term, and he's seeking for a renomination, for a nomination. He's seeking for an extension of his actually time at the head of the central bank. So pressure started coming, especially from Senator Elizabeth Warren, and people started talking because they felt like this was a total disconnect between we are the Fed, we are the central bank, and we are supposed to provide trust into the market, into the economy, and what actions of your officials, of your regional presidents are totally against what you are supposed to be showing. So it doesn't paint a pretty good image in terms of reputation, all right? So people started asking questions, putting pressure, and you will expect something to be done here. But when you look at actually the consequences of what happened, it is very, very disappointing. Why? Because not only these two guys decided to quit on their own, even though on the behind the scenes, things seems like Jerome Powell, the Fed chair, hey guys, you need to do what you need to do. So make sure you quit. Now, interestingly enough, when they wrote letters of resignation, they never mentioned anywhere these actions and these trades, even though this was the very core, the very center of them resignating, right? So President Kaplan decided to sell all the stocks, sell all the investments into, these funds, and put the money into what we call index fund, and then another part into cash. He will simply hold cash. The other president did the exact same thing, but they were forced to based on the pressure I explained earlier. Now, the thing is, on the general industry, when it comes to finance and investment world, if you work for a company that is either involved with investments, involved with money management, whether or not you hold a certain position, as a general employee, there is a code of conduct. And whenever you violate that code or those guidelines, the very first time, the money you made, any capital gains, any gains that you made by trading your personal money, whether it was based on insider trading or no, whether you get caught or no, because all of these trades are monitored, you have to disclose those trades, which they did. You have to disburse that money through donations to any specific US charity that the company allows you to give. Pretty much that money, it's not going into your pockets, it's going into a charity that the company endorses pockets, right? So first of all, that is a big disconnect here with the consequences of these violations. Now, the other thing is, the next time, and depending on the amount of those gains or the money involved into trading, you're talking about jail time here and getting simply fired. So none of these two, which are supposed to be consequences and actions on any general employee or any firm involved into the investment or money management in the US, violating the US code, none of these were actually observed and seen for these officials. Even more interesting, the vice chair, Clarida, he's still working. He's still holding his post, his role as the vice chair of the Fed, because he claimed that those moves, the money he moved from the bond market into stocks, the very eve of the chairman disclosing that public information was already scheduled ahead as part of what we call a rebalance. All right. So pretty much meaning that it was scheduled ahead and it wasn't nothing to do with that information, but it coincides with the fact that it was pretty in alignment with the shift in policy of the central bank. So to me, it is still unethical because when you look at the actual code, the guidelines, all right, it says clearly officials of the Fed should make sure and be very careful by trading personal money into investments and make sure that it doesn't coincide with what we call insider trading. Again, this is a felony, not only from the legal space, but also from the criminal space. So to me, it's also about a double measure. If markets are supposed to be transparent, if the people who are really in charge of deciding where the economy is going, how unemployment is being fought, and making sure that the policies that are in place are benefiting us in order for us to actually make sure that we still have the buying power we need to have in order to take care of ourselves, take care of our children, take care of our households, and making sure that the investment we make into the market based on trust is still there. So market transparency, market fairness, and market equity. So again, same thing we saw with the policies. Here, it seems like there is always a double measure when it comes to people in power, people with authority, and people with big pockets. So even though, to finish here, the chair, based on the pressure from senators and Congress people, decided to actually refresh the entire code and started an investigation to make sure that will never happen with any, not only any Fed official, not a high-profile guy within their organization, but also to all employees. I mean, it's kind of, a sense of an action, but it's not enough, because if they were really serious about sending a strong message, that money they made would have never been kept. It would have been dispersed the way I exposed earlier. So to me, it's still a matter of conflict of interest of people that are in power, people in Washington, people in politics, with really close ties to their privileged place and the kind of information they get ahead based on their privileged space, and making money off of it, which is not the case with the average Joe here. For example, me, if I was to make the same kind of investment. So let me know, guys, in the comment section what you think, and I see you in the next one.